Have you ever pondered on the age-old question, should I invest for the long term or should I make quick, short-term investments? If so, you're not alone. This is the investment paradox, a conundrum as old as the concept of investing itself. Understanding different investment strategies is akin to mastering the art of chess. Each move, each strategy, has its own set of rewards and risks. Our focus today is on the comparison between long-term and short-term investing. It's like comparing the strategies of a tortoise and a hare in the race of financial growth. On one hand, we have the tortoise's slow and steady approach, investing for the long haul. On the other, we have the hare's quick and nimble maneuvers, capitalizing on short-term gains. The question is, which approach will cross the finish line of financial success first? In the next few minutes, we will embark on a journey to unravel the mysteries of investing. Remember the fable of the tortoise and the hare? Let's relate it to investing. In this tale, our tortoise, a symbol of patience and perseverance, represents the approach of long-term investing. Now let's delve into the concept of long-term investing. It's not about making quick money or getting rich overnight. Rather, it's a strategy where you invest your money for a prolonged period, often years or even decades. It's the tortoise's way, slow, steady and consistent. Why would you want to be the tortoise, you ask? Well, the magic of compounding is one of the key reasons. In the world of investing, compounding is the process where the earnings from an investment are reinvested and over time they start generating their own earnings. It's like a snowball rolling down a hill, gathering more snow and gaining size as it goes along. It starts slow, but give it enough time and you'll be amazed at how much it can grow. Another advantage of being the tortoise is that it's often less risky. Yes, the markets will have their ups and downs, but if you're in it for the long haul, short-term fluctuations won't matter as much. You'll ride out the storm and come out the other side, hopefully with a tidy sum accumulated. But it's not all sunshine and rainbows. Long-term investing requires patience and a certain level of comfort with uncertainty. You need to be able to resist the temptation to withdraw your investments when the market dips or jump on the latest investment fad. It's not a strategy for the faint-hearted or the impatient. In addition, you need to be diligent in your research. You're not just picking stocks or bonds at random. You're carefully selecting investments that you believe will perform well over the long term. It's a marathon, not a sprint. So, as our friend the tortoise showed us, slow and steady can indeed win the race. But what about the hare's strategy? Now let's hop over to the hare's side of the story. Imagine the hare as a sprightly investor, always on the move, with eyes darting from one opportunity to another. This is the world of short-term investing, a bustling marketplace where speed is of the essence and decisions need to be made in the blink of an eye. In this fast-paced arena, the hare thrives. It's all about quick wins, fast trades and rapid returns. Think day trading, swing trading, or even high-frequency trading, where investors buy and sell securities within seconds. This is the hare's realm, where he leaps from one trade to another, always chasing the next big thing. But it's not all sunshine and carrots for our furry friend. The hare's strategy comes with its own set of challenges. The first one is the sheer volatility of the market. While the potential for quick returns is high, so too is the risk of losses. The market can change direction in an instant, turning a promising trade into a losing one before you've even had time to say, hare. Secondly, the short-term approach requires a significant amount of time and attention. Unlike the tortoise, who can afford to take a more leisurely pace, the hare needs to be constantly on the ball, monitoring market movements and reacting to them in real time. This can be demanding and stressful, not to mention that it requires a deep understanding of market dynamics and trading strategies. Lastly, the hare's strategy can lead to overtrading. With so many opportunities to jump on, it's easy for the hare to get carried away and make trades based on impulse rather than careful analysis. This can lead to losses that could have been avoided with a more measured approach. As we can see, the hare's tactic might seem appealing with its quick gains, but it can also lead to quick losses. It's not always about speed, is it? But what if you don't identify as either the tortoise or the hare? What if you're more of a wise owl? Let's take a flight into the realm of the owl's strategy. This is for those who believe in the power of balance, in the magic of diversification. Now, imagine your portfolio as a hearty stew. You wouldn't want it to be all potatoes or all carrots, would you? No, you'd want a mix of ingredients, each adding its own unique flavor. That's diversification in a nutshell. It's about blending the caution of the tortoise with the boldness of the hare. The beauty of this approach is that it balances risk and reward. If one investment goes south, others may flourish. It's like having your eggs in different baskets, each watched over by a wise owl. So, like the owl, sometimes the wisest choice is to have a balanced view, keeping an eye on both short-term and long-term opportunities. So, what treasures have we unearthed from our investment journey? Let's recap. We've explored the paradox of investing, discovering that there's no one-size-fits-all approach. It's all about understanding your own goals, risk tolerance, and time horizon. Are you a tortoise carefully plodding along with a long-term strategy, harnessing the power of compound interest? Or are you a hare sprinting towards short-term gains with a high-risk, high-reward mindset? Perhaps you're an owl, wisely diversifying your investments across different assets to spread the risk. Remember, it's not about picking the best strategy, but the one that's right for you. It's like choosing your favorite flavor of ice cream. There's no universal choice. It all boils down to personal preference. And let's not forget about risk management. It's the safety net that keeps you afloat when the market takes an unexpected plunge. Whether you're a tortoise, a hare, or an owl, remember, investing isn't a sprint or a marathon, it's your journey. Start it wisely,